Let me ask you something uncomfortable. What if the system you were told would help you was actually designed to keep you stuck? Not by accident, not as a side effect, by design. Today we're talking about debt, not the kind that comes from bad decisions or laziness. The kind that was built specifically for people like you, smart, hardworking people, who just never learned how the game actually works. By the end of this video, you'll see credit cards, loans, and banks completely differently. And you'll never look at a minimum payment the same way again. Let's start with a simple question. How does a bank make money? Most people say, they invest my deposits, or they charge fees. Partially true, but the real answer is simpler and darker than that. Banks make money when you borrow and struggle to pay back. Think about that for a second. A bank that gives you a loan and you pay it off immediately, that's not a great customer for them. A bank that gives you a credit card with a 24% interest rate and you carry a balance 14 years, that's their dream customer. The entire credit industry is built on one psychological insight. People underestimate how long it will take them to get out of debt. When you take out a loan, you feel like you can handle it. The monthly payment feels manageable. The interest rate sounds like just a number. What you don't visualize is the full picture. A $5,000 credit card balance at 24% interest, paying only the minimum, takes over 17 years to pay off and costs you nearly $8,000 in interest alone. You borrowed $5,000, you paid back $13,000. That's not a loan, that's a trap with paperwork. So why do smart people fall into this trap over and over again? Because the debt industry doesn't just use numbers. It uses psychology. Trick number 1, present bias. Your brain values things you have now infinitely more than things in the future. When a bank offers you $10,000 today, your brain lights up. The interest payments that start in 30 days? Your brain treats those like someone else's problem. Neuroscientists have shown that thinking about future financial consequences activates the same brain region as thinking about a stranger. Literally, you don't fully identify with the version of you that has to pay this back. Banks know this. It's why every offer leads with what you get, not what it costs. Trick number 2, the minimum payment illusion. Credit card statements are legally required to show you the minimum payment, but they're not required to make the total cost obvious. $25 minimum payment on a $1,200 balance sounds fine, completely manageable. What they don't put in bold is that at that rate, you'll be paying this off for years, and the interest will cost more than the original purchase. The minimum payment isn't designed to help you get out of debt. It's designed to keep you in it as long as possible. Trick number 3, the credit score game. Here's one of the most brilliant psychological traps ever created. Banks convinced an entire society that the measure of your financial health is how well you manage debt. Not how much you save, not how much you invest, how much you borrow and pay back on time. Your credit score is essentially a loyalty score for the debt system. The better you are at borrowing and repaying, the more they reward you with the ability to borrow more. It's not evil, but it's worth understanding what it actually is. Let's talk about what this costs at scale. The average American carries $6,000 in credit card debt at any given time. At an average interest rate of 22%, that's over $1,300 per year, just in interest. Not paying down the debt, just interest. Over a working lifetime of 40 years, that's $52,000 paid to banks for the privilege of using money you didn't have. $52,000 gone. Not invested, not saved, not spent on experiences or family. Just given to a financial institution because nobody explained how compound interest works in reverse. And here's the part that should really hit you. If instead of paying that $1,300 per year in interest you invested it at an average 8% return, over 40 years that becomes $378,000. The difference between understanding debt and not understanding it is nearly $400,000. This is not about blaming yourself. This is about understanding the rules of a game you were never taught. Here's where it flips. Debt itself isn't the enemy. Unconscious debt is the enemy. Used correctly, debt is a tool. The wealthy use debt all the time, but they use it to acquire assets, not liabilities. They borrow to buy things that generate income, not to buy things that lose value the moment they leave the store. So how do you start playing differently? Step 1. Know your number. Most people have no idea how much they're paying in interest every month across all their debt. Add it up. Credit cards, car loans, buy now, pay later, everything. That number is your monthly debt tax. Seeing it clearly is the first step to changing it. Step 2. Attack the highest interest rate first. This is called the avalanche method. List all your debts by interest rate. Put every extra dollar toward the highest rate first while paying minimums on everything else. Mathematically, this saves you the most money. Step 3. Never carry a credit card balance. Credit cards are powerful tools: cashback, fraud protection, credit building. But only if you pay them in full every single month. The moment you carry a balance, the interest wipes out every benefit. Use the card. Don't fund the bank. Step 4. Understand the difference between good debt and bad debt. A mortgage on a property that appreciates, potentially good debt. A car loan on a depreciating vehicle, typically bad debt. A credit card balance on a vacation, almost always bad debt. Every time you consider borrowing, ask one question: does this purchase go up in value or down? Here's the deeper truth underneath all of this. Debt is normalized in our culture. Everybody has it. Your parents had it. Your coworkers have it. TV shows characters living in apartments they couldn't possibly afford. When something is everywhere, it stops feeling like a choice. It feels like just the way things are, but it is a choice. And the people who recognize it as a choice are the ones who get out. The goal isn't to never use financial products. The goal is to use them consciously, on your terms, with full understanding of what they cost. Banks are not evil. They are businesses. And like any business, they optimize for their own profit. Your job is to optimize for yours. Every time you pay off a debt, you're not just reducing a number. You're buying back your own future income. You're reclaiming money that would have gone to someone else's bottom line. That's not just financial progress. That's freedom. The debt trap isn't a conspiracy. It's a system built by smart people, using real psychology to make consistent profit from people who were never taught to question it. Now you know how it works. That knowledge alone puts you ahead of most people. Start with one step this week. Just one. Calculate your total monthly interest payments. Write the number down. Look at it. That number is what awareness costs you every month. Now imagine what it feels like when it's zero. If this video made you think differently about debt, share it with someone who needs to hear it. This is exactly the kind of thing nobody teaches in school. Next video drops Friday. We're going deeper into the money game and covering the one psychological bias that makes people overspend every single time they go shopping. It's not willpower. It's not weakness. It's neuroscience. Subscribe so you don't miss it.